right, so good morning, everybody. It is August 10th, 2023. This is Assumable Loans with Linda Painter and Sarah Steadfast. It is being recorded, and if you are interested in Assumable Loans and you're looking in the future, please do check with Sarah, Linda, or your loan officer to make sure all the information that's in here is still accurate and up to date. Without further ado, I'm going to turn it over to Linda and Sarah. Thank you, ladies, for being here.
Thank you. Good morning, everyone. Sarah and I are going to go over a little bit about Assumable Loans and try to answer any questions that you all might have, because it looks like our market is slowly converting to some of those. We have some of them coming on now in our pipeline. So we thought it would be a good opportunity for us to go back and go through it again. Sarah, do you have anything to say before we get started?
Nope, I'm just going to move your slides for you and answer questions if anybody has them.
Okay. What I'm going to do is go over a lot about the assumable loans. There is only two loans that can be assumed in this market, and that's an FHA loan and that's a VA loan. And on the VA loan, the buyer and the seller have to come to the meeting of the minds as to whether the VA eligibility is going to be transferred over to the new buyer. It does not have to be, but it's at the benefit of the seller that that happens. So that being said, if he had a VA loan, a VA buyer with eligibility would be the one that is substituting his eligibility for the sellers. And so they would handle that with the lender and through the VA, so that the sellers would be released and the buyers would take over the balance on that loan. They will, once you get started, the first thing you're going to have to do is get the contract set up. And the contract, you're going to have two different things that's going to be different than what you have on a normal contract. When you get down to how much money the person is going to put down or the contract sales price, one of those have to be fluctuating. One's going to be firm and one's going to fluctuate. If it's going to be a firm contract sales price, then the balance is going to fluctuate on the loan amount, because we're not going to know what that actual loan amount is until we get to actual closing. So the difference is going to be the cash to come to close, because the buyer will probably have to come to closing now with cash. So it's either going to be cash or purchase price going to be firm. The loan balance is going to be flexible, because we don't know what that's going to be. So only one or two things are going to be firm: the cash or the purchase sales price. So that takes care of page 1 of the contract. Then we're going to get into paragraph 10, and there's 2 items in there that have to be checked. One of them is you must mark one or the other. One of them is whether, and it has to do with the seller's escrow balance. That balance is either going to be prorated, and that's usually the fairest way to go. And that means the buyer has to purchase the seller's escrow balance, and then we would calculate and prorate the interest, and we would also prorate the taxes. If it's pass gratis, the buyer gets whatever the amount is in that escrow balance, and there will be no prorations. The buyer is going to have to purchase their own homeowner's insurance, and they will also have to purchase owner's title insurance. Lender's title insurance is not a necessary item, because the lender already has that with the loan that they have, and it just passes with it. And if the buyer wants to purchase a survey, that's also another option that's out there. The recording fees that are getting transferred over to the clerk's office is going to be based on only the contract sales price. There is no recording fees for recording a deed of trust, because that's already of record at the courthouse. So we don't have to worry about that. So closing costs generally are a little bit lesser than if it's a full purchase. Now, the ones that I've had, they had an origination fee, which was a small fee that they had on our last one that they had to pay, and a credit report. And other than that, that's all that lender really charged on the closing. So the closing costs will be a little bit less, but now you're going to be dealing with a lender who's not familiar right now with doing assumptions. That part of their department and a lot of the lenders have not been set up yet. So it's going to take probably a good 60 days to get this loan approved, and it's going to be the buyer and the seller working with that lender to get that buyer approved so that they can assume that loan. You don't have a local loan officer here helping you do all that, and it'll all be done with an appointed person at the mortgage company. The buyer will not skip a mortgage payment either. So whatever or whenever we go to closing of whatever month it is, the buyer has to be prepared to make the mortgage payment that next month, because interest and everything is passing over. So they will have to make a mortgage payment on the beginning of that new month. So hopefully that lender has got everything set up and ready for them to accept that that mortgage company or that mortgage payment. The last one I did, it didn't go very smooth for our buyer, but I'm hoping they finally got that worked out, and to get all that, because they weren't going to accept his mortgage payment because they didn't know what to do with all the documentation once the assumption had taken place. But it's taken about 2 months for that also to get straightened out. I don't have any other things right now. Sarah, do you have any things you want to add?
Well, I was just going to kind of add for those of you who perhaps aren't so familiar with this. I mean, basically what we've got going on is the buyer bought a house within the last few years with a very low interest rate, and they are now trying to sell their property. And since interest rates have gone up dramatically over the last year and a half, this gives them the opportunity to get a loan at a much lower interest rate. And for those of you who were on early, I did mention that I just read an article that just affirms the idea that the mortgage company is not really that excited to let somebody assume their mortgage. They would much rather that seller paid off their mortgage and they were able to get their money back and lend that money out at 7% instead of 2.5% or 3%. So you've got that against you to start off with. The other thing is that it is a full application package that has to be sent to the mortgage company. So what happens is you find a seller who's got a 2.5%, 2.75% VA loan, and they are going to need to contact their mortgage company, let them know, contact the servicer, let the servicer know that they have somebody who's interested in assuming the loan, and they will be sent an application package which the buyer has to complete. And this application package is very similar to the application that we do when somebody comes in for a new mortgage. They're going to have 2 months bank statements. They're going to have income and employment documentation. They're going to have their pay stubs, and they're going to have to meet certain debt to income ratios. So it's really important that you understand that, and that's where RW Town Mortgage will be happy to help. Make sure that the borrower is pre-qualified. We did have one recently that after 60 days, and they said that the loan was going into underwriting and that it was going to be another 30 days, that everybody just threw their hands up and said, we're just going to get them a new mortgage. Because another thing to keep in mind is that over the last couple of years, somebody has actually paid cash down on that balance. So the value of the house has probably gone up. The cash balance or the balance of the mortgage has probably gone down. Somebody has to come up with that cash to assume that loan. And these lenders do not allow secondary financing. So you can't go get a second mortgage from a credit union or something saying, okay, well, we'll get a second mortgage to pay that difference. The lenders do not want that. They want to see that the buyer has the cash to actually put down to assume this loan. So it's not a done deal. And as Linda said, they're taking a good 60 days to get done. And I said we have one the other day that they're already into 90 days. So it's not as smooth as it can be. So you've got your pros. Absolutely, it's a low interest rate and payment that the borrower is going to, the buyer would assume. And as Linda said, they do need to get their own homeowners insurance. But nobody misses a payment when you get a new mortgage. If you closed in August, your first mortgage payment is not due until October. When you assume a loan, that first mortgage payment is going to be due September 1st. And that's one of the issues that we're also seeing, is that these lenders with these assumptions are not getting everything switched over to the new borrower in a timely fashion. So the new borrower will send off their mortgage payment to the lender and hope that it connects with the mortgage. The cons of the trends of this, it's control of the transaction. Yes, Karen, you have a question?
I'm thinking about, why would a listing agent or seller think that my offer as an assumable would be better than another offer? Because it seems like the disadvantages are to the seller. It's going to be slower to closing, and there's still this unknown because we really don't have the pre-approval in place. So the only advantage I'm thinking to the seller is that transferable eligibility, so that they can use a VA loan again in the future. Is that what you're seeing as well?
Yes, I mean, I think that we use an assumable loan in a situation where it's more of a seller's or a buyer's market. This could be perhaps they're going to offer the buyer more. We don't have an appraisal done. So there could be additional benefit, financial benefit to the seller if somebody were going to go with a higher sales price than perhaps somebody who we know has to have an appraisal done. Linda, do you have a question?
And a buyer can also buy a higher priced house with this lower interest rate if they assume that lower interest rate than if they went and got a new loan at the new 6.5%, 7% rates out there.
Right. So if they qualify, let's say, for $350,000 through a regular VA loan, but they're going to assume, then they might qualify for a higher loan.
Correct.
But they've got to come to the table cash. And so
Yeah.
I don't think I understood the math, and I haven't done it before. So let's say the purchase price is $350,000. Okay. And the seller bought the house 3 years ago at a good interest rate. Then what are the numbers that we're finding out from them? We're finding what the payoff amount is.
You want to find out what the assumable loan balance is.
Right.
What the balance is. So if they bought it then and they had no money in it, they probably only have a 325, 330. I mean, because they don't pay that down that quickly. So if they didn't put a lot of cash down, their loan is probably in 3 years is going to be very close to what it was when they took the loan out.
So let's say they purchased it for $320,000 3 years ago at a good interest rate, and now they're selling it for $350,000. Then the difference, that $30,000, is that the cash to table?
Yes, plus the closing cost.
Oh.
Yeah, the one of them that I did, the buyer had to bring like 200 and some thousand in. But
so the seller then is that they're getting the $30,000 to walk away. They're getting whatever it is, the $30,000 and the opportunity to transfer the eligibility so they can get a VA loan again.
Correct.
However, keep in mind that there's commission involved. So someone there also then has to pay the commission. So if you've got a $350,000 sales price and commissions are, say, 6%, that's $21,000. That's going to eat into that $30,000 cash that the buyer is coming to the table with. So
the seller still has their regular closing costs, the commission, the recording fees, the termites, whatever, or if they agreed to pay, seller paid closing costs, all of those things still come off the seller side. And they still have to pay the grantor's tax and that Hampton Roads transfer tax. All of that still appears and their closing costs. So the seller side is still very much the same, except depending on whether they're going to purchase that, prorate their escrow account and get that back. And then they will also be able to cancel their homeowner's insurance once the closing gets taken care of and done.
But since there's no appraisal, I think I heard you say there's no appraisal, so we could offer 365,000 on a $350,000 listing. We just have to be willing to come to the table with that extra cash.
Correct.
That's correct. And I think that's probably the whole point of this, that it sounds like such a great deal for everybody, and it's not necessarily a great deal. So I think that's absolutely something that you're bringing up great points. And so here, Joel has asked a question about, isn't it a disadvantage to the seller to allow assumption as they may lose their current benefit? And that is a possibility, Joel. So that's what we're looking at. And again, that's why we're bringing this up, that you want to make sure that the buyer has VA entitlement so that they can actually substitute their entitlement for the seller's entitlement. So that's something that you really want to do. A VA loan does not require, an assumption does not require the borrower to have entitlement, but it would be a disadvantage to the seller because they're basically still on the hook for that mortgage. Should that borrower default, that will come back and it will obliterate their need or their ability to use their VA benefit in the future. And then,
also, go ahead.
No, go ahead.
Okay, someone had asked what the closing costs are for the buyer. It's the regular settlement fee for us, and they would only have to get the owner's title insurance, and they would have to get a year's worth of insurance, and then the recording fees would be less because we're only recording on the contract sales price of the deed, and then whatever charge it is that the lender is charging to have this loan assumed. And you want to look at probably I would go on the high side with that at $2,500.
I would agree.
Yeah.
And yes, Lucy, it's absolutely possible to do a rent back during the assumption process. It's whatever you negotiate on the contract. And that's,
Yes.
I think, one of the most successful ones I've seen was one that an agent in the Lynn Haven office had, that the buyers and sellers knew each other. So they did let the buyers move in, and that one took almost 180 days to get completed. So it helped everybody because then there was rent coming in. The sellers had to move on to another duty station and had rented something where they were going, and let the buyers rent the property back from the sellers so that they at least had some money coming in.
I'm Lucy, and could I just add one more thing to that question? If the person, and I'm sorry, I apologize, I came in a few minutes late. My alarm went off and I ignored it for a second. It was too long. Anyway, if the person would like to do a rent back and that person has the cash and everything appears good, and they've been pre-approved with another company for a regular VA loan for the amount that they need. And at that point, are they pretty much a shoe-in to assume the loan?
No,
I'm afraid if they do they're not.
no, they're not. It is entirely up to that lender who is servicing that loan to determine the qualifying ability of that borrower.
Okay.
And as I keep mentioning, this lender would probably much rather get their money back from the 2.5% or 2.75% interest rate and lend it back out at 7%. So it's not a shoo-in.
And once they get all that paperwork completed, which is a lot because it's like qualifying for a new loan, where they have to have their credit cards, their bank statements, fill the application out. Any of that thing that is going to be required in that package when it comes to them, I highly advise them to make sure that that package goes in complete and that they keep copies of everything they've sent, because they'll probably have to send it a couple of times. So they're going to have to make a complete package when it goes off, whatever the items are that lender is looking for. Now, if they need any help with that application or anything like that, we'd be more than happy to sit down and help you guys as you get it, as you're going through that, because they're going to be asking you all to also help them. And I don't have a problem helping them with that process of getting, their application and everything completed. But they're going to have to do a lot of work on their end to get this all done, and they don't have a local loan officer helping them. They've got to get the package together, and they need to be able to check. They've got to be detailed and be able to check off all those items and get them all off at one time.
Okay, thank you.
All right, and Joanne has a question?
Yes, I'm sorry. I came in a little bit late, and so I'm just looking for confirmation on a couple of things. If it's a VA loan, it can only be assumed by a VA buyer, correct?
No, that is not
No.
correct.
That's not
And-
correct. It can be assumed by a regular buyer, but then the seller is not getting their entitlement back.
Until the loan has been paid off.
Correct.
Okay.
So they would then not be able to move on to another property and use their VA entitlement again.
Unless
That
they've
answer-
completely paid it off.
Unless they completely paid it off, correct?
Okay, and if it's not a VA loan, it can still be assumed. It's not just VA loans that we're looking to
It's
assume.
VA and FHA are the only loans that can be assumed right now.
Okay. All right, great. Thank you so much.
You're welcome. And Karen,
If we're working with a client who has already chosen their lender and it's not an RW Town mortgage lender, it sounds like you're recommending we still encourage them to get together with an RW Town mortgage lender just to walk through that pre-qual process and make sure, is that what I heard you say?
well, I would tell you to get with an RW Town mortgage lender to make sure, and if they've got their own lender, then I would say that's it's okay. It's because I would rather they used an RW Town mortgage lender, but as long as they have a lender, they should probably also be going along simultaneously to try and get a regular loan too, so that they are aware of what could happen, just in case, one, that servicing lender denies their loan, and two, that they just run out of time and need to be able to get into be able to get into a new mortgage.
So if they've already had the full pre-qual and underwriting done with their lender, should they also tell their lender they're considering the possibility of assumptions and ask their lender to walk them through making sure that they can qualify for that? I wasn't sure I understood what you
Yes.
were saying in that.
So let's just say, for example, Wells Fargo is the servicer of the loan in question that we're talking about assuming. And Wells Fargo makes up their own rules. There are no set rules. It does not necessarily mean they're following VA guidelines. They're going to set whatever rules Wells Fargo has in place for that particular loan. So if you have a borrower who comes to Town Bank Mortgage and says, or to RW Town Mortgage and says, okay, I'd like to look at qualifying for a new loan, just because we can get them qualified for a new loan does not in any way mean that they could qualify for that Wells Fargo assumption. Does that make sense?
Right, it does make sense. And so I'm thinking the seller needs to know that I'm thinking about how is the best way to present that offer to still make it look like a competitive offer in a multiple offer situation. And I'm actually wondering whether it would make sense to write on the offer that they are pre-qual for a regular VA loan if the assumption is not approved.
I would think so. And because again, the biggest issue on these assumptions is, other than the lender is making up their own rules on the servicing lender is the one that's making up the rules on the assumption. But the other thing is typically you're going to need some substantial down payment. And that's one of the things that we're just not seeing right now, that people have that substantial down payment to be able to actually assume that loan. So that's where the benefit does come in, that if they were pre-qualified for 100% VA loan at 7% versus trying to assume this loan at 2 3/4%, where they have to put $100,000 down, it may be a better transaction for them to actually go with the 7% new loan with the idea that they could refinance it when the rates do come back down.
Yeah, thank you. That's helpful.
Okay, great. Joanne, did you have another question?
No, I'm sorry. I accidentally raised my hand.
Okay, no worries. Just want to make sure. All right, so again, going through the cons of the transaction, it's the control. You can't walk into the loan officer in your office's office and say, what's going on with my loan? Because it's in some assumption department for the servicing lender out somewhere else. So you are not necessarily going to be able to reach somebody on a regular basis to be able to find out exactly where you are in the transaction. Time frame. As we said, 45 to 60 days, that seems to be 60 is pretty good. If you can get it done in 60 days, then that you're doing pretty well. Down payment needs, and as I had mentioned, the servicing lenders are not allowing secondary financing. So you can't say, well, I'm going to assume this loan at 320,000 and I'm going to get a second mortgage for the 30,000 to get to the sales price of 350. Lenders are not allowing that because, again, who wouldn't want the 2 3/4% money back so that they could lend it back out at 7%? So that's just something to think about. The time to consider an assumption is if the existing borrower has a high balance on their loan, so 320,000 and the sales price is 330, that's only 10,000 to assume it, but somebody still has to pay for the commission on the deal. If the interest rate on the loan is considerably lower than the market and the assuming borrower has the cash to close, that's absolutely a time to do that. During a divorce with the goal of removing an ex-spouse from an existing mortgage. That's another thing that you could do, that if you've got a husband and wife on the loan, they're going through a divorce, the wife could assume that loan from the veteran husband, if that were the way it was set up. All right, I think it didn't go.
Lisa, you have a question?
Yes, I do. I'm asking these questions because I do have a client right now who's very interested in doing an assumable. It's two people. They are not married. They are hoping to be married, but not married yet. In the future. One is a VA a veteran with the eligibility, and one is not. And they would both like to be on the loan. And if not, the second person who is not the VA eligible person would like to be on the deed. Is that possible?
Yes, that's possible.
Okay. And if that person that wants to be on the deed is the person who has the cash to put forward in the loan, is that a problem?
You would just have to go through with the lender and probably fill out a gift funds letter, just like
Okay.
on a normal loan, and they would allow the gift funds to come. Because I have had that happen where like a parent even gave the gift funds so that they could go ahead and assume the loan. So you would just still have to go through the gift funds, but that lender still has to approve that.
Okay. So they would not be on the mortgage, but they would be on the deed at that point.
Yes.
Okay. Now, this person is self-employed and income is sporadic. It's not a definite paycheck every 2 weeks. If the fully qualified, assumable or eligible VA person with the loan is capable of paying that loan in full on their own, is it a possibility that this second person who is self-employed could still be on the loan?
Probably not, would be my guess. If that's going to be the lender call, that's all going to be done through loan approval because it's going to be up to the lender. It doesn't hurt to start it out that way. The worst they could do is say just take them off the loan and then they could just be on title without obligation.
Okay.
The thing to think about is when you've got an income that you can't count, do the two borrowers together have additional debt? That if that self-employed borrower has additional debt that cannot be offset by their income, then it's as Linda said, you're probably going to want to remove the one and just put them on title.
Okay. One other question. If they do the rent back, I guess it can be written, anything can be written in the contract, then they would just have to accept the offer. But would that money go towards the mortgage of the house if it takes, say, 60 days or 120 days? Would that money be able to go towards the financing of the house, or that money that they're asking for in addition to what is financed?
Well,
I
the
would
seller
say-
still has to make their mortgage payment, so more than likely, as we know, the mortgage payments are a lot interest and a little principal. And so say you've got $2,500 in rent and the mortgage payment is $2,500, there's only a small percentage of that payment that's actually going to start reducing the principal balance, and more than likely that rent cannot be applied to the borrower's closing costs. But again, you could ask for anything.
Yeah,
True.
that would be a negotiating thing. And you know, with the deeds, for assumptions, it's an assumable deed. That's what it's called, the assumption deed. The new buyer and the seller both have to sign the deed to transfer title. So they both have to be on that deed. And also the ones that I have done, there's a little addendum that goes to the deed of trust, where that gets recorded. It's a one-page document, and both of the people have to sign that also, where they're changing the name on the deed of trust. So the lenders have come up with that. In the past, I never had that happen, but the ones now have that addendum to the deed of trust that we have to record.
Okay. And earlier I asked the question about the the cost of the buyer to assume, and I know you said that on the high side, probably $2,500. At that point, were you including the fact that they'd have to get title insurance and or
No, I would, no, that's still an additional cost, because you don't know what that new lender is going to charge. So I would say the lender side of it is the $2,500.
okay, and
then you'll
that
have
homeowners insurance is in addition to the 25 as well.
Correct.
Okay.
And the fee for the settlement agent and the recordation fees, just as you have on a new purchase, except you don't have to re-record the deed, because the deed is already there, but you do have
No,
to
the
re-record.
deed of trust, you don't have to.
I mean, sorry, the deed of trust, right.
Well, what's the $2,500 for then?
A
It's
fee
the
to the
lender's
lender
purchase.
to process the package.
Lender processing package. Okay.
Yeah.
Okay. So ultimately, it is not that much cheaper than the closing cost for a regular loan.
No,
Okay. All right. I got you.
So
Okay.
the benefit is that resulting mortgage payment, if it is at a lower interest rate, a significantly lower interest rate, the resulting mortgage payment will be lower for the buyers.
Okay. So if we start this process with the lending company, and I can call them up as their agent, as my client's agent, and say,
Not necessarily, not
no, I can't.
necessarily. I mean, that would be something that would vary by lender. It may be that you are able to, but it also may be that they say, I'm sorry, we can't talk to you. We're dealing with the buyer.
So how do I find out information well, the agents already told me what the seller's agents already told me what the assumable amount is, or what the balance is on the loan. So I'm good with that, but am I able to ask what their payments are? Because wouldn't we basically be
Oh,
getting
absolutely.
almost the
Yeah.
exact same payment, other than whatever, if there was a difference in the homeowner's insurance and that type thing?
right.
Yes.
And you could even write that in the one front part of that contract, where the approximate loan balance is whatever it is, and approximate payment. You can also put that in there, but be in mind that that payment is going to change a little bit because of the difference in whatever the homeowner's insurance premium is for a monthly basis.
Right. Okay.
But you can put that right there on that front of that contract. where you've got the assumable loan balance and what the contract balance is and the financing parts in there. And, you can also, I've seen there were also put in there what the interest rate that they're assuming this VA, FHA loan at whatever the interest rate is.
Uh-huh.
And, you can put that right there in that contract. It doesn't matter that you've written that in there. It's just a protection for both of you.
Okay.
And
Okay.
of course, the length of time it takes, the principal amount is going to be reduced each month, but it's not going to be it's not going to be reduced by much, just purely because, as we know, principal and interest.
Yeah,
Interest
that's
is
why
the
you
largest
don't
part
want
of the
that to be
payment.
fixed. That's what you want to be floating. It cannot be fixed. The only
Right.
thing you want fixed is the contract sales price or the cash to close.
Okay. Okay. Well, thanks.
Okay?
You're welcome. Karen,
Can you just bouncing off what you just said, can you go over that with a little more detail? Writing up that part of the contract, you had said if the purchase price is fluctuating, the cash to close is firm, and vice versa. If the purchase price is firm, the cash to close is fluctuating. So what does that look like on a contract and how we word that in the document?
Okay, so you're at paragraph 3 on a contract.
Mhm.
And that's where you have the contract sales price. So you can put approximate purchase price of whatever that's going to be. And then down on the second part, the down payment, you can put whatever the cash is. If it's going to be firm, that's where you'd put the firm amount that they can bring to closing. Then you get to the financing, you're going to put an assumable loan, and that is not going to be fixed. Either the cash, the purchase price, but that assumable loan thing is going to be approximate balance.
I don't understand why they're both not approximate. If we don't know the actual assumable loan price, and that's, so the purchase,
You can have everything approximate, but you want something to be firm just so you don't have an open-ended contract floating of what the sales price is going to be or the cash to come. You're going to know sort of what that assumable loan balance is by getting that from the seller when you're writing the contract. Because they're
Right.
going to know what their balance is at the time you're getting ready to write the contract. But it can't be firm because it's going to change every month until we get ready to go to closing. And the contract sales price, I would always probably want my cash to be firm, but it depends on what the buyers have. And then you're going to float, your contract sales price.
I see. So if they only have a limited amount of cash they bring to the table, that's the one you make firm and you make
Yes.
the purchase price approximate.
Absolutely.
If they can afford to have it fluctuate and maybe a little bit more, you make your
Exactly.
purchase price firm and
Yes.
cash to
Yes.
close
Yes.
based on the, okay, thank you.
Mm-hmm.
anybody else have any questions? And Linda and I are absolutely available if you've got a particular situation and we can go through them with you before you go to the effort of writing up the contract. We'll be more than happy to help you do that and kind of talk through the issues. Because as we say, there are probably more cons than pros to doing this, even though it sounds really, on the surface, it sounds really great. It's just not quite as great as it sounds.
Right. Yeah, we're available anytime.
Anybody have any other questions? Great. Well, thank you guys so much for joining today. And yeah,
Thank
Linda,
you.
All
great
right. Thank you
job.
all. All right.
And
Thank you so much.
keep us posted. Thank you so much.
Bye.